Hello, everyone, and welcome to the Capital Call, our small business advocacy team's take on an earnings release call, where you, our shareholders, join our team for a dive into what's happened over the last year in capital raising, what is on the horizon, and how capital raising trends intersect with public policy. I'm Martha Miller, Director of the SEC Small Business Advocacy Office, and I want to thank you for joining us today. Before we dive in, I'd like to turn it over to Chair Gensler to share some welcome remarks.
Hi, I'm Gary Gensler, and thank you for joining today's Capital Call hosted by our Small Business Advocacy team. Here at the Securities and Exchange Commission, we value hearing from small businesses, investors, and other stakeholders on what you are experiencing when you raise money. That's why we're doing this Capital Call. Think of it just like those earnings release calls that public companies hold from time to time. Today, we want to share some information with you, answer your questions, and yes, seek feedback. Our Small Business Advocacy Team's 2021 annual report provides a deep dive into the data on what's happening with capital raising. I encourage you to take a look. And thank you again for your interest in supporting growing companies, our economy, and the investors in the companies.
Thank you very much, Chair Gensler. Before we dive in, I want to give you a roadmap of what to expect today from the Capital Call. We're going to jumpstart with a rapid overview of the report that we delivered to Congress in December, which I encourage you to download today from the Capital Call website. After that, we're going to head straight into our policy recommendations for the report. We've got 4 key areas of focus to highlight, and you're going to hear from different team members about each. If you've engaged with our team before, you know that we believe in backing policy with data, and you'll see some highlights from our report interspersed throughout. After walking through our policy recommendations, we're going to open up the floor for the part that likely got you the most excited about today's event, the opportunity to ask us questions. To ask questions live, you must be in the Zoom event. Access credentials are available to registered participants via the Capital Call webpage. And of course, you can always listen without asking questions on the sec.gov webcast. Please chat in your questions to our team using the Q&A box within Zoom. And please don't save them all until the end. Our team is going to start putting them into a queue to be answered live alongside some of the pre-submitted questions that you shared when you register. You've heard me say team a few times already today, and what you will see is absolutely a team effort. I want to give a shout out to our office team members working behind the scenes and in front of the cameras today, including Jenny Choi, Julie Davis, Kim Dinwoody, Sebastian Gomez, Sarah Kenyon, Jenny Regal, Malika Sullivan, and Todd Van Laer, and extra kudos to Amy Reichauer, the leader of today's event. So without further ado, let's dive in, and I am going to share my screen with you and some images from the report. All right. I'm hopeful that you can see that now, and we are in good shape to go. What you'll see here is we just released our report on capital raising, and the theme of the report, you'll see some visual themes of innovation up close. Throughout the report, you will find a rich overview of data, and this is speeding through. The point is, I want you to see what's inside the report. There is so much more in here than we could possibly cover, not just in the 1 hour that we have scheduled for our event today, but in multiple hours. So take a look, dive in, and reach out to share feedback with us. We have got information on everything from the earliest stages of capital raising to IPO activity, and highlights from the work that our advisory committee did. You can download a copy, of course, on the Capital Call webpage, but there's also a link that will be permanently on our team's webpage on sec.gov/OASB, which is the lovely SEC acronym for our office. What I want to do is to dive in and explore our office's policy recommendations from the report, which we're going to contextualize alongside some of the data that we included. I mentioned there's too much in the report to cover today, so what you're going to see just skims the surface. These recommendations were based on our work throughout the year, engaging publicly and monitoring capital raising trend data. Before we move any further, we should give the obligatory SEC disclaimer that you've probably heard many times before, that the perspectives shared today are our own and not necessarily those of the Commission. I'd like to invite Amy Reischauer to join me on screen and to talk us through our first recommendation. Amy?
Thanks, Martha. It's no secret that speaking fluent securities legalese does not come naturally to most entrepreneurs, or frankly, even lawyers who don't practice securities law. When we ask founders what kind of offering they're planning to pursue, they often respond with specifics on deal terms or stages of capital raising, like I'm issuing convertible notes, or I want to do a pre-seed round. They're thinking in business terms, not CFR citations to particular securities laws or rules. Before we dive into the data, we wanted to share a story of one founder we worked with last year who encountered several complexities within the regulatory framework for offerings as she sought to grow and fund her company. Like many founders, she initially thought she'd start with venture capital, but she realized her company was too early in its growth stage. Next, she looked to friends and family, but she realized that her network was only able to write $100 or $300 checks, not $10,000 checks. So she turned to pitch competitions, and there she found success and funding, and eventually went on to raise an initial round of venture capital from family offices and high net worth individuals. So about a year later, she went to raise another round, but she received what she felt was really a predatory term sheet. So she decided to do some more research on capital raising options. That is when she discovered equity crowdfunding. She was able to turn down the predatory terms and ended up raising 3 times as much in an equity crowdfunding offering. I'm sure many entrepreneurs can relate to this founder and the complexities of the various capital raising options that she experienced. Let's take a look at how the data amplifies the need for entrepreneurial support as they try to navigate those options. Our country relies on small businesses to create new jobs, but talk to any entrepreneur and they will tell you that starting a new business is hard work. And there are plenty of reasons why startups may fail, but the number one reason is running out of cash and the inability to raise new capital. Most new companies fail not because they don't have like a great idea or service or product, but because of financial barriers. When we take a closer look at those financial barriers, we also see that they vary across demographic groups. For instance, Hispanic, Latino, and African-American Black small business owners start with 1.5 to 2 3/4 times less liquid wealth than their white counterparts. Put simply, personal wealth sets the financial starting line for many entrepreneurs. Funding is often more accessible for those who own a home or have family assets. So that wealth gap creates additional barriers to entry for many underrepresented entrepreneurs. On top of financial barriers to entry, entrepreneurs face informational barriers to entry. Half of new business founders report information, education, or knowledge as a challenge in capital raising. That's more than twice the rate for entrepreneurs with mature businesses. In other words, even for the most technically sophisticated entrepreneur, a biomedical researcher commercializing a pharmaceutical patent, an app developer pioneering novel code, or an industrial innovator scaling a clean tech solution, the language of capital raising and the nuances of our complex securities rules are often inaccessible. Great entrepreneurial insight does not translate into fluency in what's almost a century of layered securities laws. Inclusive capital markets require more accessible capital raising toolkits. Since first identifying this challenge in our 2020 annual report, we have launched a new capital raising hub on the SEC's website. Here, we equip entrepreneurs and investors with a wealth of tools and resources. Starting with our Cutting Through the Jargon glossary of key terms, this glossary makes the language of capital raising more accessible, breaking down technical legal terms into plain English. Users who are interested in more detailed information can then link from the glossary to further resources. Another tool we launched last year, our Interactive Navigator tool, helps you explore various regulatory pathways available to raise capital. By answering a series of 7 questions, you can identify the most relevant capital raising pathways based on your specific needs and find resources to help you learn more about them. You'll also find our interactive capital trends maps. We worked closely with our colleagues in the Division of Economic and Risk Analysis to develop these maps that show where and how businesses are raising capital across the country. We hope these tools will inform entrepreneurs, investors, and policymakers alike. Today, we are excited to share that we have just launched the latest in our suite of capital raising resources, our building blocks tools. These break down some of the top questions we hear about capital raising. For each topic, we tried to provide an overview of the relevant issue, as well as direct you to additional resources for those who wish to explore the concepts further. We've developed all of these resources based on feedback directly from small businesses and investors like you during our outreach. And we encourage you to reach out to our team to share your ideas on how we can build on these tools further. You can also share, as Martha mentioned, any questions that you have during today's call in our Q&A feature.
Amy, before I advance to the next slide, I have to give major kudos to you and the rest of the team for this resource launching today. I encourage you to go check out the building blocks. You'll see that we have initial building blocks there. We're going to continue to add new content. We want to hear from you on what resources would be the most helpful for you to answer the questions that you have to make the language and the ability to navigate capital raising an easier process, because that's something we continue to hear is a major need for entrepreneurs and investors. So Amy, I'll now turn it back over to you to talk a little bit more about our recommendation.
Absolutely, Martha. Definitely a team effort, and we want you, the entrepreneurs and their investors, to be part of the team. Looking ahead, we are going to continue to develop resources driven by what you tell us you need. We will also continue to advocate for policy solutions that reduce barriers to entry and minimize regulatory footfalls for entrepreneurs and their investors. After all, the public companies of tomorrow are grown by the entrepreneurs of today. With that, I'll turn it over to my colleague, Sebastian Gomez, to hear about another of our recommendations.
Thank you, Amy. It's a pleasure to be here with you today. I want to dive into our second recommendation. As many of you know, to build successful companies, startups need savvy investors who bring industry experience, customer connections, and strategic guidance. However, professional angels and venture capitalists are outside of many entrepreneurs' social and geographic networks. Just like Amy did, before we start the discussion of the data, I want to share with you another story from our outreach. We work with a founder who is a first-generation American. He initially bootstrapped his company, funding it on his own. When he needed extra funding, he first did a Kickstarter campaign. Then he moved on to regulation crowdfunding offering, and then to an angel round. On the angel investment, he found that the pricing of the round was very much tied to where his company was located, rather than the value of the company or the company's business. The founder ended up moving across the country to a bigger entrepreneurial community and is now part of a broader network of founders and potential funders. However, moving across country shouldn't be a prerequisite to capital raising success. This is just one out of many stories that we've heard from entrepreneurs facing challenges in bridging their networks. With that in mind, let's take a step back and discuss how the data illustrates this challenge. Half of the entrepreneurs have reported challenges building networks and connections, which in turn poses challenges for their startups. But these challenges are often magnified for women and minority founders. As I share the story of the first-generation American founder, where you're located still matters a lot in capital raising. In fact, this is most critical in the early stages, where angel investors tend to focus on their local communities and those within their networks. But network connections also remain critical to capital raising, even at later stages. Entrepreneurs without personal professional networks struggle to get in front of venture capitalists at a later stage to access professional networks of funding. So in a nutshell, this brings us to a recommendation. Social capital remains a prerequisite for financial capital for many. Our laws are not clear on how funders can build bridges from their own network to savvy investors. In particular, there is a lack of clarity on the role of finders in facilitating introductions between founders and investors. Yes, broker-dealers serve as intermediaries at the upper end of this market, but there remains a market gap for early-stage companies. We encourage Congress and the Commission to finalize a regulatory framework that helps bridge the networks between social and financial capital so that access to investment capital can be less about who you know and more about what you know and the innovations you bring to bear.
Sebastian,
So with that, I'm going to...
before we turn it over to Jenny, I want to jump in and just to share one of the things that I think really matters in tying this to what we were just looking at before. We're all about inclusive access to capital and looking at where there may be barriers that are impacting underrepresented founders and their investors. And so looking at ways that we can bridge networks so that your social network is not your financial network for purposes of success in building a company. That's absolutely critical. It's core to our mission and what we think about. So I just wanted to underscore that point for those who are tuning in, and also thank you for the fantastic overview of this topic, Sebastian. I'll turn it back over to you.
No, thank you, Martha. It's a great point. I'm in fact going to go ahead and turn it over to Jenny Riegel, who's going to guide us through our next recommendation. Jenny?
Thank you, Sebastian. When businesses look for funding beyond friends and family or their local angel network, they very often turn to private funds of sophisticated pooled capital, such as VC funds. Emerging fund managers play an important role in the capital raising ecosystem. They are more likely to invest in a diverse pool of entrepreneurs, as well as entrepreneurs located in areas not traditionally served by established fund managers. However, funds raised by emerging fund managers are on the decline, as investment decision-making is increasingly concentrated in the hands of a few. Many fund managers we hear from see 3C1 of the Investment Company Act as a barrier to entry, particularly for women and people of color. One manager described seeing her fellow Black women in tech being overlooked by investors. She raised a venture fund to invest in these women and amplify their stories. Another manager explained how she felt stuck. She had a limited network of accredited investors that were only able to write smaller checks. The current caps in 3C1 hampered her ability to pay herself and her employees. Yet another emerging manager faced the same challenges with his personal network, turning to general solicitation under Rule 506C to increase his network of sophisticated investors. We've seen a lot of attention on founder diversity, but to bring equitable funding to scale, we need to look upstream to the people controlling the capital. Now, let's turn to the data. Many of you may be familiar with the statistics showing how women founders continue to receive less funding, VC funding, relative to men. Minority-founded companies also continue to raise less capital than their white founder counterparts. Not surprisingly, there's a connection between who writes the checks and who receives the funding. We talk about pattern matching a lot, so let's dig into the statistics on the investor pool. Women remain underrepresented among angel investors. The same is true for minority angel investors, who are vastly underrepresented compared to the broader population. These trends among angels are not dissimilar to the trends among venture capitalists, where we see women vastly underrepresented among investment partners, also known as the people with the power to allocate funds. That said, we have seen incremental progress in representation in recent years. Similarly, we continue to see underrepresentation of minorities among decision makers at venture capital firms, although some modest progress has been made in recent years. In fact, over half of firms report having recently brought on more diverse leadership. Yet work remains. Diversity among funders directly impacts diversity among who is funded. While many sophisticated investors recognize the bias inherent in pattern matching to the typical example of a successful, young, white male entrepreneur, it is critical that we empower diverse investment decision makers who can support and invest in solutions to the problems that they too face. Emerging fund managers and their smaller funds are more likely to invest in a more diverse pool of entrepreneurs, as well as entrepreneurs located in areas not traditionally served by more established fund managers. However, funds raised by emerging fund managers are on the decline. We support.
Jenny, before we jump to the next slide, I wanted to just pause really quickly because Jenny's going to give the kind of the recap of how we think that these issues can be worked on. I hope that you're spotting that there are themes and trends here. None of these issues exist in isolation. We see the issues of those earliest barriers to access having impacts that ripple across your financial network and the ways that you reach people. We see the same issues of representation among the founders who raise capital also being reflected in the funders who are able to raise capital to then deploy and to back. So I just wanted to highlight the interrelatedness of the issues that we see. None of these things exist in a vacuum, and they're complex issues which require complex solutions that we're flagging here today. But Jenny, I'm going to turn it back over to you to talk through our recommendations here.
Thank you. Excellent point, Martha. To our recommendation, we support a number of policy solutions that were raised during our 2021 Emerging Fund Manager series that I highly recommend you check out if you have not seen it yet, and recommended by the SEC's Small Business Capital Formation Advisory Committee, including raising the $10 million limit on the 3C1 qualifying venture fund exemption and amending the venture capital fund definition under the Investment Advisors Act to permit larger VC funds to invest in other smaller VC funds as a qualifying investment. While supporting emerging fund managers is but one solution to the diversity challenges facing early stage capital industry, it is a critical one. So taking a step back, while the fund of funds recommendations may be self-explanatory, let's break down why the $10 million 3C1 qualifying venture capital fund size is impractical for many. For purposes of this example, let's assume that an investor wanted to raise a $10 million fund and charge a management and performance fees of 2 and 20. That means for about 10 years, until the fund realizes any profit, the only operational funding it has is $200,000 per year. That would need to cover salaries, compliance, diligence, portfolio management costs, an amount so low that it functionally sets these small funds up to fail. Increasing the fund limit would equip emerging fund managers and smaller regional funds with a pathway to raise meaningful capital, while also covering their operational expenses without charging an outside fee to investors. Before I turn it over to Jenny Troy to discuss our final recommendation, I wanted to give a quick reminder to the audience to add your capital raising questions for our team into the Q&A. Jenny?
Thanks, Jenny. Turning over to our last recommendation. So 2021 was a banner year for public market activity, but all too often, smaller public companies were not a part of the headline stories. Yet their impact on our public markets is critical to vibrant portfolios for investors, and access to our highly liquid markets are critical to many capital-intensive businesses. So let's explore a story of a biotech company that grew from an academic spinout to a small public company. So given the capital-intensive needs of funding research and clinical trials, many biotech companies find that an IPO is the only option to repeatedly raise the amount of money needed. While public markets provided the CEO with access to capital, she also saw certain challenges that smaller public companies face. She found that smaller public companies often struggle to get the attention of investors, especially with the limited number of analysts who tend to focus on higher market cap companies. She also found it difficult to know who her investors were at any given time, making it challenging to engage and understand her investors' concerns. On top of these challenges, she also saw that some biotech companies would have a high market cap of $2 billion based on their intellectual property, but only 50 or 60 employees to run the entire company. In other words, the market valuation of the company does not correlate with the complexity of operations or the scale of the company's staff and resources. Her story sums up many of the challenges that smaller public companies face. Now, with that in mind, let's turn to the data. So last year, we saw record amounts raised in public offerings and record numbers of companies going public compared to recent years. When taking a closer look at these offerings, we saw significant growth, not only in traditional IPOs, but also in SPAC offerings. So one interesting point we wanted to highlight is that when we look at exchange-listed IPOs in the last decade, the majority of these IPOs are those of VC-backed companies, reflecting the critical nature of pre-IPO capital raised in the private markets that really prepares companies for the public markets. Now, diving into smaller public companies in particular, we also saw growth in equity offerings, both in number and amount of proceeds last year, with a spike in Q1 of 2021. And when broken down by industry, business services and technology saw the most drastic increases among equity offerings by smaller public companies, with healthcare continuing to dominate in terms of the amount of capital raised. So going back to the story that I shared earlier, generally biotech companies would fall in the healthcare industry that is leading the public equity offerings. The experience of smaller public companies often differs from that of their large and mega cap counterparts. For example, on average, smaller public companies have the largest percentage of retail investors, in fact, twice the percentage of larger companies, while having the smallest percentage of institutional investors. This feeds into challenges with obtaining research coverage, which then impacts liquidity. So the vibrancy of our capital markets depends on having companies of varying sizes, from microcap to mega cap, to provide investors with meaningful options for investment, the trademark of our public markets. In developing rules to improve disclosures to investors, it is critical to be mindful of how and whether our rules are promoting an environment that fosters smaller public companies going and remaining public. We support efforts to continue tailoring the disclosure framework to the complexity and operation size of companies, either by scaling obligations or delaying compliance for the smallest of the public companies, especially when it comes to new or expanded disclosure requirements. And now I'll turn it over to Sebastian for Q&A.
And Sebastian, before we jump in, Jenny, fantastic job giving an overview of the activity happening in the public markets with a spotlight on the role of smaller public companies. I do want to draw the common thread together that the companies that we see going public are the companies that are being built by entrepreneurs today and that are raising capital, preparing themselves. And so as we look at calls for increased diversity among leadership and the way that companies are governed and led in the public markets, it's critical that we keep in mind that the diversity of the founders who are able to raise that seed round and then to go on and to connect with the sophisticated venture fund that can help them navigate those pre-IPO rounds and prepare for the public offering. That diversity thread and the challenges that we see in the earliest stages have ripple effects in the pipeline of public companies that we see. There's plenty more on this covered in our annual report, but I wanted to make sure to highlight that because I think it is critical to zoom out and not just look at individual elements of the market, but to look at the big picture and how it all interrelates. I'm going to stop sharing my slides now and screen, and that will allow us to dive into some of the Q&A from the audience. Sebastian, will you lead us through that?
Me too. And for everyone in the audience, this is your opportunity. Please use the Q&A feature on Zoom to type in your question or a comment that you would like to share. This is the part that is like the earnings calls. And if you ever listen to one of those earnings calls, you know that the press is desperate to ask questions. So I hope that you will chime in with your questions. We received several already, so I will start with the ones we have while you type your questions or additional questions in the Q&A. Martha and Jenny, the first question comes from George, and it relates to the proposed finders exemptive order that the Commission issued on October 9th, 2020. Specifically, George notes that an exemptive order in line with the proposal would materially aid my business and clients who seek funding but are too small to attract the firms registered as broker-dealers. So I support the proposed order. Those were George's words. He notes that the annual report indicates that this order has not been finalized, and he asked if there has been any change about that. Is there any legislation incorporating this that is being considered? And if so, which committees would have jurisdiction? Martha, I turn it over to you to get started.
Yeah, George, you are obviously paying attention and you realize the complexities of getting any sort of changes here when you're asking about committees of jurisdiction, SEC, you realize that this is a complex issue. And that was one of the things that we heard in the comments that came in for the proposed exemptive order. It is not something that is currently on the SEC's agenda to tackle in the short term, but something that our office remains committed to exploring. We continue to hear interest about it, whether from members on the Hill or from those within the SEC, but time will tell. I think it's a complex topic, George. It's one that we recognize would have a very big impact, particularly for companies like yours who may not be served by broker dealers who are preferring to work on much larger size deals. So I appreciate your interest in the topic. And certainly if you have ideas or suggestions for pathway forward, we welcome engaging with you on those.
And I also just wanted to add in that thank you for sharing your views with us. And it sounds like you've already weighed in on the comment file, but if you have market statistics, if you have data that you can help kind of better explain the need and the market need, that is always helpful for the rule writers when they're considering different policy suggestions. While the comment period has officially closed, you can always continue to weigh in not only with our office and engage with our office. We're happy to meet and speak with you, but also feel free to weigh in on the rule writing process if you've not yet gotten a chance.
Thank you both. I'm going to read one of the comments that came in from Patrick because it does relate to the issue of finding your investors. And I thought it was an interesting thing to know before I jump to the next question. He says that one of the unintended consequences of the pandemic is that we have seen many angel groups who have now expanded the geographic area of the entrepreneurs they will consider. We're also seeing considerably more syndication opportunities between groups. All good things if the current trends continue.
I agree with that, and I appreciate Pat sharing that. There's two sides to the coin of everybody meeting via Zoom for the last almost 2 years. One of them is that we can meet with people across the entire globe and do it in real time, and that opens opportunities. And so that has absolutely been a wonderful thing that has benefited a number of founders. The flip side of that is I know that I'm not bumping into and making new friends on Zoom quite as often, much less too many new investment opportunities. And so that is also a challenge that we've heard founders say, is that it sometimes is really hard to forge those new connections, but when you're able to find the investors who recognize that talent and wonderful companies exist everywhere and are willing to invest outside of their own backyard and community, it is a fantastic thing for the entire entrepreneurial ecosystem. So fantastic point from Pat there.
Patrick had a question as well. He noted that in recent times, the SEC talked about opening up accredited investors by adding a measure of sophistication that would allow those who don't meet financial thresholds to invest in private offerings. Are there future plans to add new measures and expand those who are eligible? And perhaps before we jump specifically to address that part of the question, maybe Martha or Jenny, one of you could just briefly share what was that the commission did when it last made the changes to the accredited investor definition.
So Jenny, do you want to give the recap, the high level overview of the changes that were put into effect in 2020, and then I will talk looking ahead?
Happy to. So in 2020, the end of 2019, the commission adopted changes to the accredited investor definition. And what it did is it brought in this element of who is who has the knowledge necessary to be able to be considered an accredited investor, and this idea of what experience would qualify someone to be an accredited investor. And so they brought in essentially people who have different different series exams, whether being investment advisors and different experience that is qualifying them as an investment. And that was kind of the first time that that definition had been brought in. We recently released a resource today on our website. Amy had mentioned it earlier in her discussion, that walks through and does a brief cheat sheet on this definition. And it has kind of, you can see each of the different components, whether you are an individual or whether you are an entity, and how you would qualify. And so that is available as a resource online. We can share the link in the chat. That will help kind of give an explanation, kind of looking at what is the definition today.
Excellent. So a couple of changes that were made, as Jenny mentioned, in recent years. The accredited investor definition is something that is on the SEC's agenda to look at in the short term. And for those who are not familiar, similar to public companies who tell you a little bit about what their plans are so that their investors can have a sense of what the future looks like for that company. And it comes with all the lovely disclaimers that public companies make. The SEC also puts out our regulatory agenda, and that gives you a roadmap of the potential rulemakings and areas of focus that the commission plans to pursue. And so accredited investor is on the agenda for a look. And right now there's nothing public that is available as to the parameters, but to the extent that you have ideas, suggestions, or areas that you think should be of focus, please feel free to reach out and to share that feedback with us. It is certainly, I don't think there's anyone out there who would say accredited investor as a concept is perfectly honed. It is a very complicated area to figure out exactly how you define it and create a workable definition that is also an inclusive definition that also has investor protection in mind. And so if you have ideas, we welcome hearing those from you, because this is a perennial favorite topic in early stage capital raising, that there is always room for improvement when we talk about this term in particular.
Both. Our next question comes from Thomas. He notes that the temporary COVID rules for regulation crowdfunding are scheduled to expire in August of this year. Had there been any discussions around extending or implementing those changes permanently?
That is a great question, Thomas, and something that our team worked on behind the scenes quite a bit when COVID, it's hard to believe, back in March of 2020, when we were thinking that we would be back in the office by May, but we saw what was happening with businesses shutting their doors. And then we realized May, that's not happening, at least not May of 2020. So we looked at the dire straits that small businesses were in, and particularly the challenges that they faced with needing capital and needing it in a way that was more accessible than the framework allowed at that point. In between, the emergency relief that was provided for crowdfunding issuers, we had some changes to the rules that were adopted on a permanent basis as a part of the harmonization concept release that was then put into adoption. Those rules didn't implement all of those emergency measures, but they did go about making some changes that improved the efficacy of crowdfunding. One of the biggest ones was actually raising the total dollar amount from just about $1 million to $5 million, and that vastly expanded the utility of crowdfunding as an offering pathway. Now, that said, if you're asking this question, it's because you probably appreciate the nuances of the financial statements and the different things that you have to provide, and in what order for your Form C to go through and for the portal to be registered, not to be registered, for the portal to be ready to start helping you with your offering. Right now, there are no plans that I'm aware of to change that, but again, that is something that could change in the future. If you've got specific thoughts on it, I encourage you to reach out. And Jenny, feel free to share any additional insights if you have any there.
No, I think that's a great suggestion. But yes, we welcome hearing how it sounds like you're most concerned about the conditional exemption that allowed someone to do an offering up to $250,000 without reviewed financial statements. And we would love to hear how that's working in the market, what you're hearing back from investors and issuers, and how that's working. So if you have insight, please feel free to reach out to us, and we'd be happy to, we would love to hear your thoughts on kind of what you're seeing in the marketplace.
The questions keep piling on, so I'm going to keep going with them. This is great. I'm going to combine the next two questions, and I love these two questions because they show the sophistication of the audience joining us today. We got a question that is closely tied to our third recommendation in the annual report. And it notes that if the recommendation is to raise the fund limit above 10 million, what is the thought on what the new limit should be? And will it be tied to a limit on limited partners? Will that be raised above the current 249 level if the recommendation is accepted? And I'm going to tie it to another question because this shows the level of sophistication of our audience. And that question is, what committee chairman or subcommittee chair do we write to encourage rule changes that would possibly result in better fundraising for Black-owned or other minority companies?
I love these questions because it's somebody who's really diving in, not just on the mechanics of something. Anytime we start speaking in regulatory citations, which unfortunately everybody just still refers to them as 3C1 funds, but anytime we start diving into the mechanics here and then thinking about, okay, committees of jurisdiction and who might actually push this forward, I'll actually answer the questions in reverse from how you asked them, Sebastian. So what I would say is, if you're thinking about reaching out to members of Congress, those who are on House Financial Services and Senate Banking Committees are the two committees of jurisdiction that would be the most likely to work on this topic. And it's something that I know there's a number of members who care deeply about, and they recognize the challenges with a $10 million threshold. To the question on where, I think, Sebastian, you said, where will the threshold move? I think the operative question is, where should the threshold move, whether that is the dollar amount or the number of investors. You know, from our perspective, Jenny included and showed a whiteboard calculation of what that looks like with a 2% annual management fee that's charged on the assets under management. That's 2% is often the upper end of the management fee. Sometimes it's as low as 1%. That's really hard to do for a new fund. I think that as we look at what that dollar amount cap should be, it needs to take into consideration that the solution for the funds surviving and being able to operate is not to charge investors higher fees. That's not a good deal for investors. It is instead to make sure that we are right sizing and scaling so that the size of the fund enables the operations of that fund to be successful. There's a lot of numbers that you hear tossed around. Some people say that, you know, raising a fund below $40 or $50 million really is just functionally hard to do and to actually make it from an operations perspective. We hear others, including the SEC Small Business Advisory Committee, that weighed in and said, you know what, that dollar amount should be closer to $150 million. And there's not a one specific number that is magical. It really has to be practically driven. And we also need to look at making sure that that number provides sufficient flexibility moving forward so that we're not having this same conversation in 3 or 4 years as we look at potential inflation and changing dynamics in the market. So that is a long-winded answer to the question on the dollar amount, and it relates very closely to the number of investors. And again, lots of different perspectives on whether that number should be raised from 250 investors. And I've heard all the arguments in different directions on that, from those who say, you know what, I'm happy with the 250 if you could just raise the dollar amount. And then I also hear from those who say, do you know what, I really need you to raise the number of investors because that would enable me to have a more inclusive cap table that brings in more women and people of color as my limited partners who may not be able to write as big of a check, but right now I have to turn them away if I'm looking at a limit that makes me decide between someone who can write a $25,000 check and someone who can write a $250,000 check. So fantastic questions, and I welcome your engagement with us on where you think those lines should be drawn in the future.
Thank you, Martha. The next question is a question that we hear a lot about, and it's this intersection of finance and new technologies. And specifically, are there any specific rules, laws, or things to consider for organizations, companies, which are looking to utilize the blockchain for their transactions or business protocols?
That's a great question. In terms of resources, I'm not sure the resources that we have internally for a blockchain-enabled technology as you're looking at kind of the company and its operations. What I will say is we've seen some interesting innovations with the use of blockchain-enabled technology for management of cap tables and investors who are a part of that company. To the extent that that question then morphs into looking at blockchain and digital asset related questions, we have got a fantastic team here at the SEC in our FinHub led by Val Zapanik. I encourage you to go and check out the resources that they have online. They see a lot of repeat questions that are asked on topics that are very timely, and they try to provide answers to those publicly online so that there is good dissemination of information. So again, they go by the name FinHub, and they often host office hours and opportunities for you to engage directly with staff. So that answer goes in multiple different directions, from saying that there's a lot of wonderful things that are happening when companies are embedding blockchain as a part of how they build products and services. It's bringing really interesting innovations to bear from an efficient cap table perspective. And then as we look at digital assets, there is obviously a lot happening in that space, and our FinHub team is a fantastic dedicated resource on that topic.
Thank you,
Excellent.
Martha.
And
Go ahead,
I shared
Jenny.
shared a copy of the FinHub link in the chat. So if people want to go check it out, recommend you do so. Thank you.
Thank you, Jenny.
Thank you, Jenny. The next question relates to Regulation A. It's a little technical, so bear with me. I'll read
right.
it. And Jenny, maybe you can provide a little more context on this one as the two of you answer it. In connection with Regulation A, Tier 2 offerings, many of my trading clients have expressed a desire to have pricing flexibility rather than a fixed pricing only for a Regulation A Tier 2 offering. For example, companies trading in OTC, NASDAQ, and other exchanges trading systems. Is there any exploration of the at-the-market pricing by supplement for trading companies rather than by post-qualification amendment only? This flexibility would broaden utility for a good exemption. It's a great question. It's very technical. So for those of you who are not deep in the weeds of Regulation A, Jenny is an expert on this topic. Jenny, you could probably provide a little bit of context about what an at-the-market pricing offering is and how Reg A works.
Before Jenny goes in and just pulls from her encyclopedic knowledge of all things Reg A, for those who are listening and are saying Reg A, I'm not quite as familiar. This is often what some people refer to as a mini IPO. It is where you can raise up to $75 million through something that is less than becoming a full-on registered company and going through that S1 registration statement process. So Jenny, you dive into the weeds, but I wanted to make sure that I gave the context for those that are listening and thinking, okay, I know crowdfunding, I know Reg D, but Reg A, that's a different one that's not in my vernacular.
No, and that's great. And I won't go too far in the weeds. I mean, this is a high-level discussion, and we can always talk specifics after the fact. But essentially, to do an at-the-market offering with SEC for a public offering, you do need to be S3 eligible. And S3 eligible means a shelf registration statement, and that provision requires to use a shelf registration statement, you do need to have met certain requirements. And it goes to how long you've been a public company and other requirements. And so part of the rules of Regulation A is that it doesn't permit at-the-market offerings. And so that's kind of the historical basis of why you do need a fixed price to be doing a Regulation A offering. It also applies to offerings that are conducted under Form S1, which is a registration statement with the SEC. And so there is kind of a historical context behind the no at-the-market offerings. And I don't need to go into rule citations and kind of the background of it, but it is based in that. And Regulation A is intended to be a way to offer to the public, but using kind of a mini IPO, using the requirements have been reduced so that people can be able to better access the public markets and potentially provide a pathway to becoming a registered company. And so it is a unique situation where regulation does allow offerings up to, again, that 75 million mark, and you can offer them to retail investors. But there are certain conditions and requirements because of that retail investor component, and because the offerings are public and done online in a very broad way. And so that it is part of the rules that, and again, it relates back to the historical context of why out-the-market offerings were permitted for more established companies under Form S3.
And before we go to the next question, if you were wondering why Jenny Regal is our policy manager, that right there, her encyclopedic knowledge and the fact that she can drill in, and I have yet to find a question that you can ask that can stump Jenny on the most hyper technical of topics, and it spans many a topic. But Jenny, thank you very much. Again, very grateful for you on the team and all that you bring to it.
Yes, thank you for that, Jenny and Rebecca. If you have follow-up questions or you'd like to discuss to you and anyone else on the call, feel free to reach out to our office. We'll be happy to chat. We only have a few minutes left, so I'm going to go ahead and take one more question from the audience, and then we'll see where we are after this one, if we have any more time or not. This question comes from Nicola. Really promising to see the increase in funding to women entrepreneurs up 7% year over year. Angel Resource Institute's 2020 report, unfortunately, though, continues to show disparities of valuation of up to 70% by gender at the seed stage, which has material effect as the companies continue to scale. Are there any thoughts, policy recommendations, looking at disclosures or reporting around valuation by gender and ethnicity?
That's a great question. There's a lot of third-party data that is out there. PitchBook is probably, I think, the best and the market leader on this topic, but it is an area of real interest. And if you dive into our report, one of the things that did not make the slide deck today that I think is really relevant to the question you're asking was looking at the differentials in valuation depending on who the founder is, and not surprisingly, given that it's something that's being tracked and reported on, women tend to raise less money at a lower valuation. And when you multiply those two factors together, that means that female founders are giving up more of their company and more of the equity in their company to investors for the same amount that they're raising, and that ultimately hampers long-term their wealth building prospects, the returns that they receive out of the company. There are similar trends among minority-backed companies and minority-led companies. It's something that we pay close attention to. It's not something that the SEC tracks on a valuation basis, but it is something that our team recognizes as critical. It's one of those elements of capital raising. You can't just look at the dollar amounts that are raised. We have to look at all of the different variables, the same things that investors are looking at, that funds when they're tracking their portfolio and how it's performing. And when companies are looking at potential investors and figuring out who's the right fit, we're looking at those same things because those market dynamics and the individual elements of them matter critically. And they weave in very closely to the policy recommendations that we've shared and into the reasons that we really believe we need better diversity, not just among the founders, but among the people that are writing the checks, because there are two sides of that equation, and it's absolutely essential that we work on solving for both.
Thank you, Martha. And someone in the chat just asked about the name of the data set that the question had referred to.
PitchBook is who I referred to. There's also, if you look in our report, you will also spot there's some other independent academics and researchers who are also looking at this topic and running their own very interesting analyses there. So encourage you to start with our report, because what we try to do is to take relevant and insightful information from not just the SEC's data sources, but those who are studying it externally to the SEC, and to compile that into a single resource that can be your go-to when you're trying to understand the state of what is happening in capital raising activity. So again, encourage you to check out that report, because there's a lot in there that I think you'll find interesting.
And we're happy to have critical feedback. If there are suggestions or data points that we didn't consider, please reach out and let us know. We love feedback, whether it's critical or whether it's positive. We love hearing what is working and what is not working. So if you see a data source that you think we should consider for next year's annual report, please send it along. If you have a policy suggestion that you think we should be considering, please let us know. Reach out. We'd love to hear kind of your potential solutions on how to address these problems that are critical for our market. So we welcome ideas and we welcome engagement. So please reach out and share ideas, share data resources, share stories of what you've experienced in the market.
Thank you, Jenny. And if you go to our website, you will find how to contact us. There's a phone number. We love to chat to you on the phone. There's also an email if you prefer email. Just let us know. Martha, we're almost at the top of the hour, so I am going to turn it over to you for you to close out our capital call.
That sounds great. And Sebastian, you were thinking right along the same lines that I was. So if you have additional questions, or you're looking for a copy of that report or access to some resources that we've talked about today, I encourage you to check out our team's website. We have lots that is there. And as Jenny was mentioning, we don't view anything as a static state. It's perfect as is. We are always looking to incrementally improve and to build things that are valuable to you. So I encourage you, if you spot something, whether it is a resource, whether it is a perspective or an idea that you think that we need to be taking into consideration, we want to hear from you and to incorporate that into the work that we are doing. As we wrap up today, I just want to say a big thank you to each of our participants who joined us. This event is a fun and engaging event because you take the time out of your day to join us, to ask us questions, to engage and to share the perspectives that you bring. They are invaluable. It is what makes our work so much more fun than it would be if we just sat in offices in DC and worked in isolation. And it wouldn't be the advocacy work that we do without engaging with you. So thank you for joining us today. Again, thank you to the entire team for putting on such a wonderful event. And I look forward to hopefully engaging with you in the very distant future. Stay safe and healthy, everyone.